it's a lot of the clients that have previously gone direct, or they haven't got a relationship with their broker, that leave it to the last minute, who panic the most.
When I speak to clients and they tell me, oh yeah, the rent's been the same for 3 years, I'm like, what? I was like, you're getting £800 a month now.
Yeah.
If we were to remarket this, it could easily get 12.
It doesn't get any worse than someone who calls you and they've already made the decision rather than calling to discuss it. And as you say, it's because their mortgage is about to go up in 7 days' time.
Yeah.
Hi, welcome back to another episode of the Investors Corner. Today we have a returning guest, Scott from SWS, a mortgage brokerage based across Berkshire, Surrey and Hampshire. Scott, thanks for coming back in to see us. We really should get a broker in every 36 hours
At the moment,
I think at the moment. So it's much appreciated that you're spending the time with us to go through what's going on in the mortgage market. We were just going on off camera, the changes and new mortgage products that are being provided. So I'm quite keen to hear about different options for people, because we've got a real two-pace split market at the moment. Myself and Andy as letting agents, as a lot of landlords are exiting the market, down to, if you listen to the podcast with our solicitor last week, you'll know why. A lot of people are being scared off, and the arguments for and against that. But it's leaving an opportunity for a lot of landlords to buy in. And I've got a few landlords in our portfolio who are looking at buying 1, 2 and 3 more properties. So thanks for coming back on firstly. Standard question, how's the market?
Yeah, good question, and thanks for having me, guys. The market is, it depends who you talk to, right? But from my perspective, the market is still really good. People want to buy. It's just making the numbers work, and whether it's an emotional purchase for your residential, or whether it is for an investment property. But the market's still buoyant. People still want to buy. I guess the biggest thing that's holding people back at the moment is interest rates, which obviously there might be a change in the base rate today. Which doesn't necessarily have an effect on the fixed rates, more of the swap rates, which we'll potentially go into. But yeah, I think that as long as the right intention is there to buy, we're still seeing a lot of properties get snapped up, and it's still then turned into business for me for purchases. But then also clients are remortgaging, and a lot of my clients that are buy-to-let landlords that are remortgaging are releasing equity to buy more properties, because they're leveraging their money and their properties, because the rents have gone up as well. So that helps quite a lot.
Yeah, the big change to rents must make it easier for you actually writing a buy-to-let mortgage, because we had a couple of years where, whilst rates were very, very low, the mortgage didn't stack up against the purchase price didn't stack up against the rental income, because
the purchase price have just gone up so much over the last few years. And yeah, that has helped. Like a couple of the clients that I'm looking at the moment, their rents have put up like 25 to 30% in some areas, but that has come sort of over the last couple of years. But also interesting fact that a lot of landlords don't know, but I've also found out a lot of brokers don't know, because I've won business this way. But a lot of lenders will go by the current market value of the rental market, or by the current rents that the tenants are paying. And obviously, if the landlord hasn't put it up over the last couple of years, they're not going to be able to get the loan that they need. But some will use the current market value, which massively helps. So if, for example, a mortgage that I've recently done for a client, she's only getting £450 a month for her property, and she's in negotiations with the tenant at the moment to put it up, but the current market value is 600. So it's massively helped her get a higher loan, and she's remortgaged from about 55% loan to value back up to 75%, released that 23k of equity from her property, which she's then investing into more property. So it does have a massive impact, the interest rates, but because, as you said, the rents have gone up, I think statistically anywhere, depends where you are in the UK, but anywhere from 15 to 30% in some places.
Yeah, and I think that's the piece of information that current landlords need to make an informed decision. So we were speaking before the podcast in the fact that because rental prices have increased, if that landlord actually took the advice, they might not have raised the rent for 2, 3, 4 years, because
Sometimes
they
longer,
deal with that tenancy themselves, or they manage it themselves. So when I speak to clients and they tell me, oh yeah, the rent's been the same for 3 years, I'm like, what? I was like, you're getting £800 a month now. If we were to remarket this, it could easily get 12. So we're talking about £400 more a month, and you're telling me that you want to sell because the numbers don't stack up now.
Yeah.
It's just like there are ways to keep you in the market, keep hold of your asset by getting that rent that the property deserves and what the market rate is. So yeah, it's just things like that. It's just the educational piece to.
I think it's a good tip though. Is it lender specific that some will look at the market rate over what's on the contract? Because some landlords don't want to put their tenants' rent up. They've got a friendly relationship with them, whatever the reason might be. There might be something that's just mean they've got an agreement between them of whatever reason that they're going to keep the rent at way below market value. But if they can still leverage the assets rather than being held against it, because generally speaking, we will advise people to increase the rent on their mortgage on their rental, because when remortgage comes round, they're going to be in trouble if they don't, more than it because we want to screw tenants over, because we don't. That's not our interest. It's more we think if you get way behind here, when the remortgage comes up, there might be an issue.
Yeah, and that's the challenging thing at the moment with a lot of clients that have got their remortgages coming up, whether it's 2 or 5 year fix that they did a few years ago, is that it's difficult to remortgage them. We're having to stick with their own lender, which not necessarily a bad thing, because some lenders do look after their existing clients and offer them retention products, which sometimes are better than sort of remortgaging. Sometimes there's less fees, etc. But we do find that it is a lot of the time it's best to remortgage to get a better rate. But to answer your question, yeah, there's only a couple of lenders that will take the current market value as opposed to the rental that they're currently receiving. And the main reason for that is because the lender doesn't want to overlend to the client, because if the mortgage payment is close to what the rent is, then they might fall on to difficult times. But with that, that's where our advice comes in. And we obviously want to make sure that, yes, you might be able to get this mortgage, but we also want to make sure you can afford it if there's any difficulties or if there's any void periods. But this client specifically, she also had the ability to top slice, which I'm sure you guys have sort of spoken about a few times before. But as long as they've got the personal income as well to back that up and they're aware of all the risks, clients are happy to sort of leverage their money.
It makes a massive difference, I think, in the market. If there is, it's just having options open for people first and foremost, rather than just a closed book of this is what we do and these are the guidelines. There's never a black and white instance when you're talking about people with historic buy-to-let specifically.
I don't think that. I think a lot of people think there is a black and white answer. I have a lot of new clients that come to me that have always just gone direct, and they're with high street banks, and they've said, "Oh, look, my high street bank can't offer me X, Y, and Z." They speak to us, and we can look at a whole wide range of mortgages and sort of open up different options. So I think it's just having that conversation with landlords and people that are worried about what the rates are going to do and the rental prices and stuff. And I think it's just having that educational touch point with them to ensure that they're aware of all the options available before making a decision to sell the property.
So where are we now? Mid-August, 4 months odd of the year to go. Are we looking at the last Bank of England base rate rise of the year, or where's your opinion sitting? Is that why a lot of your landlords are sitting on their hands waiting to see if things are going to drop off?
Yeah, it's a good question. So the base rate is 5% as we talk, but it's probably going to be going up today. And there's a lot of people thinking quarter or even 0.5%. So I personally think it's probably go up 0.25%. We'll find out later today, and when this podcast goes out. But I also think there's a lot of people that are sitting and waiting, because if they've got a tenant in the property and they're not losing money, then they can afford to wait. But it does also depend on what their sort of plans are. So I think if there's people that were thinking of selling next year anyway, and their products coming to an end, maybe they're going to sell sooner rather than later. But I think you probably wouldn't win those clients back anyway, because they've decided they're selling next year. So what's selling next year, sort of 6 to 12 months earlier? But yeah, I think it's just those clients that are maybe sort of on sort of 50-50 on the fence about what to do. And it'll be interesting to see what rates do over the next few weeks or in a few months.
I think that's what a lot of people are waiting to see. And where housing markets slow down is where people don't know what's going to happen, positive or negative. They'll sit and wait to see what happens. So if we think rates are going to come down, traditionally people will wait. If we think rates are going to go up, sometimes we get an influx and then a wait. So everything that I've ever spoken to brokers is about, well, why do you need to wait? You can book a rate for 6 months. Where are we now on that? Is that still the case of, look, if just secure your buy to let, secure your rate, and if things get better, well, we can reapply.
Yeah, no, exactly that. So all of my existing clients that I did mortgages for 2 and sort of 5 years ago, I reach out to them sort of 7 to 6 months before their product comes to an end, so we can look at all options. And at the end of the day, with most lenders, there's no upfront costs because we usually add the arrangement fee to the loan. So to secure the rate, there's no disadvantage to the clients apart from securing the product early. And as you said, if rates do come down in that 6-month period, we can move them over to the lower rate and reapply. So that's definitely a conversation to have with landlords. But then it's a lot of the clients that have previously gone direct, or they haven't got a relationship with their broker, that leave it to the last minute, who panic the most, I find. And then they're the ones that make the sporadic decision to sell sooner rather than later, without having conversations with people like us.
Yeah, it doesn't get any worse than someone who calls you and they've already made the decision rather than calling to discuss it. And as you say, it's because their mortgage is about to go up in 7 days' time, or their mortgage has just, their new mortgage payments just come out, and that's what's triggered them. There's a big change coming in the mortgage industry with Consumer Duty. How is that going to help people? Is that going to hinder people? And what about from the broker's point of view?
Yeah, Consumer Duty is mainly coming in from a regulated side of things. So it may not affect, it won't affect the buy-to-let market so much. It's more treating customers fairly in terms of fees, being honest, being transparent, and mainly on the regulated side of things. So it's not really going to affect the traditional buy-to-let market that we guys predominantly deal with. But it's definitely had a massive impact in terms of the conversations we're having with clients about signposting, and ensuring that they're aware of all their different options and fees and timescales and everything else that comes into sort of making a decision on their next mortgage. For sure.
So buy-to-let mortgages then. So what sort of ratios are we looking at on buy-to-let mortgages now, with sort of percentage-wise? So we used to talk about 75%, 20%, 25% deposit. Has that now sort of changed, and has the affordability levels changed percentage-wise? What are we looking at right now?
Yeah, it's a really good question. I think that historically and even now, most people who buy a buy-to-let property, they think, I've got 25% deposit, I can buy a property, I can buy an investment property. That's not the case anymore.
It really should be.
And the main reason for that is because of the stress test. So lenders want to ensure that the money they're lending to clients, they can afford it, with the interest rates being what they are, but they also then add on a certain stress test on top of that. It's usually anywhere, for example, if the interest rate at the moment for buy-to-lets is, let's just say 6%, which 75% mortgages at the moment. It does depend whether it's in personal name, limited company, and what type of property, so whether it's a family home, HMO, etc. But most buy-to-let mortgages at the moment are between 5.5% to 6.5%.
Right.
So if you are taking that amount, so if you're taking the mortgage amount, adding on the sort of 1.5% to 2%, and then it's got to be 125 to 150% on top of that, it just doesn't work at 75% loan to value at the moment. And that's mainly in the south. There are areas in the UK, especially sort of up north in Wales and Scotland, where it can fit at 75%, and that's mainly because the rental prices have gone up, but the property prices haven't sort of really followed what they've done in the south. But yeah, where rates are at the moment, it just seems, when I look at the rates daily, I just can't believe how high they are compared to what they were 6, even 12 months ago. Where the mortgages that my clients are on, let's say they did a 2-year fix 2 years ago and it's sort of coming up to an end, most of them are probably between 2 to 2.5%, and now they're going to 5.5%, 6%. So yeah, it'd be interesting to sort of see what rates do, but I'm positive. I think a lot of the people that have properties are in it long term.
Mm.
And especially the ones that are buying properties. Ones that are remortgaging, it's a slightly different conversation. But people getting into the buy-to-let market, you're looking at it long term. No one buys a property to sell it within 3, 4,
Yeah.
5 years. It's sort of 10, 15, 20 years, whether it's your pension or retirement, or you wanted to sort of take over your day job. So I think a lot of the people that are getting into the market now are aware of everything that's going on. And as long as they're not losing money on the property, they're still buying the buy-to-let property because they know it's going to pay off. But also, a lot of the people that are buying buy-to-let properties now, maybe they're slightly more run down, so they can get it for 10, 15% less than maybe what it's worth, spend a little bit of money on it, and then recycle their money and then invest that again into more properties.
Yeah, I think looking at the market, there are a couple of beauties out there that you can get for a good price and to make it work for you. It's funny that you say about the north. We were speaking before, weren't we, about north there, investments up north, and looking at the rental yields up there, they're ranging from like 7% to 10%.
Sometimes even higher, yeah.
Sometimes even higher, as in down here around sort of southeast, they're ranging at about 5.5. So there's a lot of stuff going up north at the moment. So with investments, look, your typical area that you normally invest in might not be the right area to invest in right now, but there are other areas in the country where you can just put your money in and get a good return on.
Yeah, and I think it's just having that conversation with the client to sort of find out exactly what they want. You know, some people just want to get the keys and rent it out straight away, but then some people are happy to do some work to the property. Some people buy sort of 3 or 4 bedroom house and then turn it into multi-unit flats, etc. So it all depends on how much time and money they want to spend in the investing side of things. But the good thing I like about this job, every single client is different, so I'm having completely different conversations with people every day, and that's where our advice sort of comes into play. But a lot of the clients that I deal with as well, I tell them I'm a landlord, so they ask for my opinion, and if we all ask the same question to each other now, we'd probably all have a slightly different opinion on investing in money, time, location. So it's just a real hot topic at the moment.
So Scott, leading question: if you're not watching on YouTube, when Andy said 7 to 10 minutes, a little smile broke across your face, like you know a little bit more than over 7 to 10. And I'd happen to know you own a few properties scattered around the UK in different investment hotspots. Being from the south, in Berkshire specifically, I look at northern properties and I think, yeah, great. So the return is good. But if I'm remortgaging them every 2 to 5 years with the arrangement fees and this, that, and the other, surely once you strip out all of those costs, the hassle factor of getting £600 or £700 a month per unit is wiped out. What do you think?
It's a good question. It's a really good question. I've asked this myself many times, and because one of the hardest things about having a property is managing it and maintenance and any issues you've got. So when it's so far away, it's difficult, and you have to trust agents in that area and sort of build relationships with them. But I think that once you've got the property, it's interesting because you can see the properties like that. They go up a lot slower than what they do in the south, but they do go up in value historically, probably like anywhere from 2 to 4% year on year. And although you're not making as much from the properties, you can buy more. So, for example, if you had 100 grand in the bank and you wanted to invest in buy-to-let properties, but you weren't sure whether to do it down here in the south or up north, with a 25% deposit, which is still stacking, to sort of come back to the stress test, which is still sort of stacking up north, you could probably buy 3 or 4 properties with that 100 grand, where down here you'd only get 1. So then you've got to put everything into an Excel spreadsheet and sort of see whether the numbers stack up. And I think a lot of the time people, because they're in it for the long term, they know that the properties that are down here in the south will go up in value much more. So if that is a long-term plan of theirs to have the property, they would do that, because yes, they may not be making the same rental yield, but over the next 10, 20 years, if that's their retirement plan, that property will be worth a lot more.
Comes back to your why.
Yes.
which I think has been mentioned about 1 billion times. It needs to be a big neon light on that wall. What is your why? Why are you doing this? Because I think it's still, and I'm sure you get the same inquiries. I'm thinking about buying a buy to let. Why? Because I've got money in the bank. And it seems like the obvious thing to do. There's not really a plan behind it, which is why people end up buying within 3 miles of their own home, because it's somewhere they're confident in, somewhere they know. And as you say, if you've got £100,000, which is a significant amount of money in anyone's bank account, in Bracknell, you'll probably get a 2-bedroom flat as a buy to let. You might be lucky enough to buy a 2-bedroom freehold, and that will wipe you out, as opposed to spreading that around and mitigating your risk of having maybe 4 tenants or 3 tenants in different properties, 2 properties covering the other one if one's ever empty, and those sorts of things. It's always been my question, though, if remortgages hit £2,000 arrangement fees, does it then wipe out your mortgage, wipe out your rental income for the next 3 months, because rental income's lower?
Yeah, no, definitely. And so I think I sort of scattered over your question last time with the arrangement fees and what have you. So it's a good point. And we find that most lenders offer 2 products. So they offer a product with a lower interest rate, but it's got a arrangement fee or a higher arrangement fee. And then they've got products with a higher interest rate, but no fee. And most of the time, it does depend on a few factors. But if the total loan is about between 100 and 150, it usually works out better going for the one with no fee, but with a higher rate. And that could change the monthly payments anywhere from 50 to a couple of £100. But then if you're looking at the initial 2 years or 5 years, it could be cheaper. But I guess that's our job as a broker, to sort of go through the options with the clients, because if you are fixing for 2 years, you've got to factor in the arrangement fees, potentially a valuation fee, broker fees, etc. However, what we find is that a lot of the buy-to-let mortgages we have to put on a 5-year fixed, simply because lenders offer a better stress test. And in the market that we're in at the moment, a lot of deals aren't fitting at 75%, but they're also not fitting at 2-year deals. So we're putting a lot of buy-to-lets on 5-year fixes, which clients are happy to do that, as long as they are aware of the risks and sort of the benefits of doing that, because it's then difficult if the property goes up in value in year 2 or year 3. It's then difficult to sort of refinance that. But I think it just comes down to having that conversation with the clients and making sure they're getting the right advice, because I still see so many landlords that just think they know the mortgage market, or they think that they can just go to a certain bank because they look after them and they've banked with them for years and years. Some banks offer retention products, but again, you're not getting the advice that you need. And a lot of the time, if you can release equity from that property and you can use that money to make you more money, it's definitely a conversation to have.
Yeah, I mean, spoiler alert, no bank's looking to look after you.
Yeah.
I feel like I'm allowed to say that, but you might not be.
Yeah. No comment.
Yeah. Mike has dropped a fact.
But it comes back to what you said earlier, is get a working spreadsheet on it. Because I hadn't considered it that way, that just pay the higher interest rate if it's a lower amount on your loan, because my properties have always been in the southeast, where you've got a big number on the sheet, so you pay the arrangement fee to keep your interest rate down. Once you hit a certain point in the UK, north of Watford Gap somewhere, then maybe that opinion changes totally.
Yeah, definitely. And it just comes down to our advice and sort of going through that with the client, because sometimes it's very, very marginal. So sometimes clients don't mind adding the arrangement fee and going for a lower rate to help with the cash flow, the monthly cash flow, even though they know it's probably going to cost them a little bit more after 2 to 5 years. And I think that with the arrangement fee, a lot of lenders have increased their arrangement fees over the last year or so, with rates going up. And some of them, especially for the limited company and maybe the specialist mortgages, so HMOs or multi-unit blocks, some of the arrangement fees are done in percentages, so 2, even 3%. So it can be a hefty fee on top of everything else that you're paying for.
So mortgage broker, property investor, where we stand right now, you can get 5% on your savings, where without your mortgage broker's hat on, totally unregulated, nobody watching from the FCA, where are you putting your money right now?
When I personally put in my money.
Yeah, what's your opinion on it?
I'm still buying properties. I think now is a good time to buy, but you have to be more careful about the properties that you're going for. And I think long gone are the days are where, yeah, you can buy a property, 25% deposit, it's going to rent out easy peasy, and the numbers are going to work regardless. You've got to be a lot more careful these days. And I think there's been a lot of changes over the last, I want to say 20 years, 10 years, even the last 2 years with investing in property, mainly because of a lot of regulations coming in. And the guidelines changing, obviously the EPC, where landlords have to be more careful. But personally, for me, I am looking into still buying properties this year. So I looked at a property yesterday. It's not the right fit. We just couldn't make the numbers work. But I think HMOs are a growing market, mainly because a couple of reasons for that. Mainly because I think a lot of people can't afford to rent a 1 or 2 bedroom flat these days, especially in this area. They go from anywhere from 900 to 12, 1300.
Yeah, easily, yeah.
For a 1 bedroom flat. But they want their own living arrangements. They want their own ensuite. They want their own garden, etc. So they're looking at the HMOs. So I think that's a growing market, and the rental yields are usually much higher in the HMOs. A lot of the time they should be sort of in the double figures, so like 10% plus. But then there's a lot more risk for landlords, but the rewards can be much better. So if you do the HMO strategy right, that's going to be beneficial. But also looking at properties that are run down. I think you mentioned it earlier, Andy, where there's a lot of properties at the moment where sellers are desperate to sell.
Yeah.
For numerous reasons. And I think there's probably a lot of properties at the moment that are selling for 5-10% less than what they would have done a couple of years ago.
Yeah.
But I think it's just being a little bit more selective about what properties you buy at the moment.
Yeah. Well, I mean, just going back to so on the HMO things while we're on here. So there's been a lot of talk about HMO. Now, there wasn't a lot of talk previously regarding it, but now it seems to be a new investment opportunity that more and more people are sort of looking into and taking note of. So what's the sort of initial outlay on a average HMO? So we were talking earlier about one that's come up, needs a lot of work doing, can't make the numbers work. But on your average one, because you've got some,
yes,
haven't you?
Yeah.
So what's the sort of average outlay on a HMO that gets you started sort of into it, really?
Yeah, so it depends on whether you're buying the HMO that's already set up as a HMO. That would be the cost of that, and the outlay would be similar just to buying your standard buy-to-let with 20-25% deposit. We actually bought ours with 20% deposit, which you can't do at the moment because they just don't stack up. But if a lot of people that are buying HMOs at the moment, or buying properties that they want to turn into HMOs, shall I say, are run down properties that were maybe family homes, maybe probate, or maybe rental properties that landlords are now selling and they haven't really looked after them. That's why they're getting sort of the lower end of the market, that are sort of your 3 to 4 bedroom houses that have potential to change into maybe a 5, 6, 7 bed, because they've either got 2 reception rooms, or they've got potential to extend out the back or into the loft. So I guess the initial outlay would be the initial deposit and stamp duty and fees that you would have with any purchase, but then also working out how much money you need to spend to get the property ready to be a HMO. And that could range from whether you just need to change one of the reception rooms to a bedroom, so you turn it into a 3 or 4 bedroom, so that wouldn't cost that much, or if you're renovating the whole property, because there's a lot of guidelines and regulations you have to follow to make sure that the property fits all of that.
So there could be a lump sum that you need to pay up front, really, to get that property sort of ready. Because you've got communal areas to think about as well. So there's a lot of stuff that goes into the HMOs, and a lot you've got to think about, a lot of management things as well you've got to think about. But like you said, if you do it properly, and you're renting out each room for £750, £800 a month, then it's going to work out a lot better yield wise compared to just the normal buy-to-let property.
Yeah, and I feel like a lot of people that are moving into the HMOs these days are sort of young professional people that want somewhere really nice to live. So they're happy to pay top dollar, should we say, for the rooms, if it's anywhere from 650 to 800, somewhere a little bit more, depending on how big, if it's got an ensuite, location, etc. So you do really have to spend money on making sure that it's done up to a really good standard to attract the right people. But yeah, I think HMOs are growing, so that's where we're looking at the moment. But then there's also a lot of buildings that were old offices and old commercials that we were talking about earlier, which people are turning into residential property. So I think a lot of landlords are now going to be sort of looking at that as well.
Yeah, easier regulations and that.
Easier regulations. A lot of times no planning permission needed. It's just under permitted development. It can go through quicker, and you're not really changing the structure of the building itself. You're more just changing the insides of it and just kitting it out, which can be much more cost effective than doing something like a HMO where you've got to be knocking down walls or extensions or loft conversions, which with building materials and labour, most of that's gone up a lot over the last couple of years as well. So the less work you have to do to the property can be beneficial. But I think a lot of people that are getting into sort of the landlord space at the moment, we're not expecting to make much money in the first year or two because we've just got to cover our costs.
Yeah, no, absolutely.
So Scott, coming towards the end of 2023, you're a specialist in the landlord space because you are one yourself. And regardless of whether you're talking about buying property, whether you're talking about this, whether you're talking about that, I would always want to sit opposite someone who's walked a mile in my shoes if I'm taking advice off them. Firstly, what are your 3 tips for landlords coming towards the end of the year to look out for, or to run away from, or to run towards?
Mm-hmm. So yeah, my top 3 tips for landlords to finish out the end of the year and sort of look for in properties, or just general advice, is to ensure that the properties that you're looking at have the needs to potentially change the marketing if you needed to. So for example, if you need to change it from a family home to a HMO or vice versa. But then also the demand in the area, just to make sure that there is enough tenants in the area. And a lot of the time that comes down to the amenities. So you've got the job opportunities, you've got the transport, you've got the shops, you've got the entertainment. So I think a lot of landlords used to sort of go in and see a property they like and thought it would rent out quite quickly. Just want to make sure that it's in a good area.
Why did you buy it? Because it was cheap. Yeah, there's a reason for that.
There's a reason for that. And then you struggle to rent it out, or you won't get the price that you're expecting. But I think one of the biggest tips, and this isn't specifically about buying a property, but it's speaking to experts, speaking to mortgage brokers, speaking to your accountant as well, to make sure that you're getting the right tax advice. So whether you're buying it in a personal name, limited company, whatever it may be, but then to also speak to guys like yourself to find out what the rental market's doing, what price they're doing, what the demand's like. But yeah, overall, I don't think people reach out enough to get the right advice. So that would probably be the biggest tip, I would say.
Yeah, I think just on that, it's about thinking about it as an investment. So if we're investing in stocks, shares, I'll drop crypto in there because I like a little dabble. But if we were investing in that, the first thing I'll be doing would be speaking to people already within that industry and saying, right, what's coming up? What's doing well? What's not doing so well? Have you got any thoughts on this? I've been looking at it for the past year and it seems to have gone up and up and up and up. So with those type of investments, you get that advice from everywhere. But it just seems that if you've got a buy to let or something like that, that you don't really hear any questions on it. You know, how's the current market doing? You know, what can I do with this money? Where should I put it into? What should I buy? Right, what do these reforms mean in the rental sector? No one seems to be asking a lot of questions on that. So I think it's just changing the mindset and thinking, right, this property, it is my investment. I'm going to look after it as an investment, like I would do if I'm pumping money into something else. And like you said, having that, and we've said this before about having that power team around you and speaking to the correct people, correct times, and getting that advice. You know, that's something that I would do if I had an investment. I'm sure you two would do it as well. I would just need more people to have an outlook like that and get in contact.
Yeah,
basically
before making a rash decision about what they're going to be doing with the property or with their money. And I think, a lot of the people that are sort of getting into the buy-to-let market these days, they're the right type of people that are asking the questions. And I think podcasts like this and everything else that you can find online really helps people educate themselves, but then also reach out for help,
Yeah, I think so. Just don't take what you see sort of in the media or online or anything like that. Don't assume that is correct and that you need to listen to that. Speak to people that are actually dealing with things in that industry and within your investment, and go from there before making any decisions.
Check the agenda of that individual. And on that note, Scott, thanks for joining us again this week. If you've enjoyed what you heard, click the subscribe button. We're here every single week, most of the time with a really, really good guest. If there's ever a guest that you want to see and hear on our podcast, put in the suggestions. But Scott, as ever, if you want to get in touch with Scott, his contact details will be in the show notes across our social media. He'll be happy to speak to you about any questions that you've got. Till next week, thanks again.
Thank you.
Thanks, Mike.
Why have we made the Investors Corner podcast, Ian?
I think online at the moment there is just way too much noise, waffle and nonsense. Everyone's got an agenda. So the goal was to make a podcast for people that want to invest money in property or other areas where there's no waffle, there's no nonsense, there's no agenda. It's opinion led, but it's an honest opinion. And it might not be the right answer, but we're going to share it.
So on the podcast, we're going to supply people with access to mortgage brokers, financial advisors, planning experts, development consultants, everything around the property industry and the wider fields.
Yeah, so if you're looking at investing in the future, you know that just having an income from your employer or from your business is not enough to give you the life that you want down the line. We're going to hopefully give you some of those answers that will give you the solutions you need for the future.
So please hit the subscribe button. The more subscribers we get, the better guests that we can get on and the more people that we can reach. So hit subscribe.